Steve, I'll start with you. You've been involved with Uber as an advisor, as an investor since the early days. Is today a day of celebration, or the price decline and the relatively underwhelming total market cap, is that making it a disappointment?
Well, the entire early employee, investor, advisor base, we all spent time today, and the mood is celebration. It's about the 10-year mark almost since the founding of the company, and I think a lot of people are just super excited to see the next stage of growth happen. And the liquidity and the ability to be in the public market is something that everyone, 100% of the employee base, has been looking forward to as well.
Dan, you know, you were pretty bullish going into today. I read your note. You're talking about a $100 billion plus valuation. Are you nervous about the way it traded on its first day?
No, we're not. I mean, look, definitely a little stumble out of the gate, but just given the Lyft train wreck and what investors saw there, that's really the skittishness in terms of this name, as well as just the overall tech tape. But we take a step back. Some of the parts, I view this as a $100 billion plus company, especially with the three-head monster value of ride sharing, eats, and freight, and as well as autonomous. So in our opinion, this does not in any way take us away from our bull thesis. And in our opinion, it's an opportunity in a choppy tech tape.
Mark, what do you think it is that has weighed both on Lyft and on Uber relative to where expectations were a few months ago? And is it a warning sign for other IPOs to come?
I think this is a statement about path to profitability. And this is a statement to people who put money in the late rounds of other private companies at big valuations, which is you got to have a path to profitability. And raising $8 billion is nothing to sneeze about. But you look at companies that have recently gone public that do have that path, and you look at Zoom, one company we mentioned a lot over the last few weeks we haven't mentioned today, but that stock's up 5% today. And contrast that with Uber and Lyft, and it tells me that paths to profitability are what investors are looking at, and the IPO tape is fine, but you got to price it right, you got to have a path to profitability.
Below 43 again, 42.96, down 4.5%. So, Steve, I mean, as an investor, what do you see as the key difference between Uber and Lyft, and why do you think that they're going to offer different prospects for investors?
Well, as we know, Lyft is domestically focused in the U.S. They're also very focused on ride sharing as their primary product. Uber is diversified. They're essentially a software logistics company that's global. They have ride sharing, they have Uber Eats, which is the delivery courier business, and they have the ATG business, which is constantly expanding out into Uber Elevate, which is approaching flying VTOL cars in local air traffic and autonomous vehicles. So what you have is a software logistics network with the types of network effects that you would expect from that. And then you have Lyft, which is focused on ride sharing just in the U.S. So you have a pretty different business at this point.
Dan, can you see them becoming profitable? This question is pre the sort of autonomous driving years. Can they become profitable while they still have such big rivals like Lyft in the home market, or do they have to merge or agree not to continue to undercut each other on price?
Yeah, I think, look, that's the $100 billion question here in terms of why it's a little bit of a battleground stock in terms of those focused on profitability over the next 3 to 5 years versus the long-term sum of the parts on Uber. Look, I think it's going to be very difficult for them in the next 3 to 5 years to be profitable core ride sharing. You know, I think the way that they're ultimately profitable is going to be on autonomous and really Eats as well as freight, the key to really the monetization of the platform. And that's why right now that from a profitability continues to be far out, which is why we're in unprecedented territory. And in our opinion, you have to view some of the parts where this is going over the next 5, 7, 10 years. But no doubt, that's why there's a line in the sand here between the bulls and the bears, with profitability really front and center.
Yeah, bears are kind of winning out right now. Mark, here's my big question. If the total addressable market, you know, there's this huge opportunity for growth in ride sharing and food delivery and in disrupting the freight business. If it is in the trillions, as the company has laid out in its filings to go public, I think $5.7 trillion on ride sharing, more than that if you add in the other businesses, why is revenue growth slowing?
Well, it's a competitive marketplace. It's a marketplace that's had lots of premium priced into it, and right now they're having to subsidize a lot of that market. And we see duopolies, obviously, in the States, and we'll see other competitors for Uber as they go more global. I think the issue right now in this bull-bear argument that you're going to have over the next few years is deep down, is ride-sharing a good business? Are taxis a good business? Is delivery a good business or not? Are those businesses really good businesses? They have $8 billion to go play with it and figure out whether it is or is not. Right now, like we said, the bulls may be losing a little bit, but it's too early to tell. I do think there's a humongous market ahead of them, and can they do that profitably is what Dara's got to figure out. I put the money on him for now, but again, the Bears have won so far because this is not the splash that everybody wanted.